Tesla at $4,500 by 2032 sounds impossible until you stop treating it like a stock chart and start treating it like an execution map. At a working price around $425, $4,500 is a little over a 10 times move. By 2032, with about 3.79 billion modeled diluted shares, that means Tesla has to clear roughly $17 trillion of market value. The model says the target clears when 6 events stack in the right order: Cybercab production, Robotaxi scale, FSD subscriptions, energy storage, AI compute, and Optimus factory output. This is the $4,500 map. Quick frame. This is education and research, not personal investment advice. The rest of the video is the model, the numbers, the events, the timing, and the valuation bridge. Start with the launch board. Tesla is not starting from zero. In Q1 2026, Tesla reported about $22.4 billion of revenue, 4.2% operating margin, $44.7 billion of cash and investments, 358,000 vehicle deliveries, 8.8 gigawatt hours of storage deployed, and 1.28 million active FSD subscriptions. That base matters. The base business funds the platform transition. The stock stops trading like only an auto company when the market sees the platform pieces becoming measurable. Here is the clean target math. $4,500 per share in 2032 requires about $17.0 trillion of market cap. The current modeled path only gets to about $1,800 per share by 2032. A delayed 2040 value, discounted back at 12%, gets to about $2,688 per share. That does not clear the target. The success case clears because the scale appears inside the 2032 window. 16 million Robotaxis, 55 million Optimus units, platform-scale FSD and AI value, and energy storage as a major industrial business. That success case reaches about $18.2 trillion, or roughly $47.98 per share. The order is the story. First, Cybercab volume production moves the dedicated autonomy product into production. Then, the first Optimus line becomes measurable. Then, FSD subscriptions start behaving like a platform, not a feature. Then, the 1 million Robotaxi gate becomes visible. Then, unit economics prove that Robotaxi vehicles are earning assets, not just cars. Then, Optimus factory capacity compounds into tens of millions. By 2032, the model needs 16 million Robotaxis and 55 million Optimus units visible enough for the market to price the future before every dollar has already arrived. Robotaxi is a 10 million to 20 million unit platform in this model, not a 100 million unit assumption. That correction matters. The 2032 success case uses 16 million Robotaxis. At roughly $12,857 of operating profit per vehicle, that is about $206 billion of operating profit. At a platform multiple around 26.9 times, Robotaxi contributes roughly $5.5 trillion of gross segment value. That is why each event matters. City launches, paid miles, utilization, Cybercab output, and proof that the fleet can earn at scale. Optimus is the biggest lever in the model. The near proof point is a first-generation production line designed around 1 million robots per year. The economic proof point is 20 million robots at $5,000 of profit per robot. That equals $100 billion of operating profit. $5,000 is deliberate. We are not assuming $20,000 of profit per robot because at real scale, robotics attracts competition, price pressure, and lower margin. The thesis still works on volume with a reasonable profit margin. The 2032 success case is larger, 55 million Optimus units. At $5,000 per robot, that is $275 billion of operating profit before the multiple. This is the math audit slide, and this is where the story has to be exact. 20 million Optimus robots times $5,000 of profit per robot equals $100 billion of operating profit. $100 billion at a 30 times multiple equals $3 trillion of gross value. That is the point. The model does not need a fantasy $20,000 profit per robot. It uses $5,000 because competition and pricing pressure should exist in a giant robotics market. Now scale the same logic. 55 million robots at $5,000 profit creates $275 billion of operating profit. That is why Optimus gets its own valuation frame. The corrected unit ramp keeps the two platforms separate. Robotaxi is the 10 million to 20 million platform. Optimus is the 100 million unit platform. Mixing those two numbers breaks the model. For the 2032 target, the aggressive case is specific: 16 million Robotaxis and 55 million Optimus units. After that, the later high-scale case can extend toward 20 million Robotaxis and 100 million Optimus units. The curve is not smooth. It moves in jumps when factories, cities, and paid usage prove the next step. This is the execution bridge. The core auto and services business gives the model a floor. Energy adds industrial scale. FSD software adds high-margin platform economics. AI compute adds infrastructure value. Then Robotaxi and Optimus create the vertical leap. In the 2032 success case, the bridge is roughly $1.5 trillion from auto and services, about $1.1 trillion from energy, about $1.1 trillion from FSD, about $1.0 trillion from AI compute, about $5.5 trillion from Robotaxi, and about $7.5 trillion from Optimus. Together, the stack reaches about $18.2 trillion. This is the calendar moves graph. The green path is top-notch execution: 16 million Robotaxis and 55 million Optimus units visible by 2032. That path clears the $4,500 line in 2032. In this model, it lands around $47.98 per share. The red path is slower execution. If factory compounding and Robotaxi scale arrive later, the target moves toward the 2040 window instead. Discounted cash flow is the discipline underneath it. A huge future value is not automatically a 2032 stock price. The market has to see the scale inside the target window. This slide shows both paths. The green path is the top execution case: 16 million Robotaxis and 55 million Optimus units visible by 2032. That path clears the $4,500 line in 2032. In this model, it lands around $47.98 per share. The red path is the slower calendar stress test. If execution stays closer to the ordinary path, with slower factory compounding, slower Robotaxi scale, and wider uncertainty around margins and multiples, the target clusters closer to 2040. That is the full message. Top-notch execution pulls the target into 2032. Slower execution pushes the same destination toward the later calendar. Here is the event calendar. 2026. Cybercab volume production is the first major gate. 2027. Optimus output becomes measurable. 2028. FSD scale starts to look like a platform. 2029. The 1 million Robotaxi gate becomes visible. 2030. Paid miles prove cash-flowing fleet economics. 2031. Factories compound. 2032. The $4,500 case clears if 16 million Robotaxis and 55 million Optimus units are visible. 2040 is the later high-scale robotics case, with 100 million Optimus units. Final model call. Tesla reaches $4,500 by 2032 when the market sees 16 million Robotaxis, 55 million Optimus units, platform-scale FSD, energy storage as a major business, AI compute value, and a core Tesla business strong enough to fund the transition. The success case reaches about $18.2 trillion of market cap and roughly $47.98 per share. That clears the target. The key is execution speed. If Robotaxi and Optimus scale aggressively, 2032 becomes the year to watch. Now I want your model. Which assumption is too low? Does Tesla beat 16 million Robotaxis by 2032? Does Optimus beat 55 million units? Does profit per robot go above $5,000? Or does the market pay a higher multiple once factory output becomes visible? Put your strongest reason in the comments. If this kind of event-driven stock model is useful, subscribe, press the bell, and leave your Tesla thesis below. We read the best arguments and use them to sharpen the next model.